வணக்கம். Course concepts. This is particularly for accounting for decision making course offered by the Anna University as per the regulation 2021. This is concepts related to this course at a glance in the maximum shortest sentences and words. Others, those who are related to this accounting, to learn these concepts can also learn. Unit 1, Bookkeeping. Recording the business transaction systematically on day-to-day basis. Account. A record in an accounting system that tracks the financial activities such as expense, revenue, assets, liability and capital. Double entry, a system of accounting in which two aspects, that is debit and credit for each transactions are recorded. Father of double entry, Luca Pacioli from Italy. Accounting, a process of recording financial transactions and includes summarizing, analyzing and reporting the transactions to oversight agencies, regulators and tax collection entities. Journal, a book of original entry. Ledger, it is an account having two sides, left side and right side. Left side debit, right side credit to post the journal entries. Narration, a brief explanation for each transaction recorded in journal. Trial balance, a list of all debit and credit balances for checking the accuracy. Manufacturing account, an account prepared to find the cost of manufacturing. Trading account, an account prepared to find the gross profit or gross loss during a period. Profit and loss account, an account prepared to find out the net profit or net loss for a particular period. Balance sheet, a statement of assets and liabilities prepared to find the financial position on a particular date. Capital, investment made by the proprietor or owner into the business. Drawing, amount or any belonging taken from the business by the proprietor or owner for his or her personal use. Now, interest on capital. Interest charged by the owner on his capital introduced. Interest on drawings. Interest charged by the business for the amount taken by the owner from the business. Unexpected expenses. An amount paid for any expenses in advance or before the occurrence. Outstanding expenses, expenses already incurred but not paid. Unexpected income, income received in advance or income received before it is actually earned. Bad debts, definite unrecoverable credit sales. Doubtful debts, the credit sales amount which may or may not be recovered. Depreciation, decrease or decline in the value of an asset due to passage of time or continuous usage. Fixed asset, long-term tangible assets that a firm owns and uses to produce income and is not expected to be used or sold within 1 year. Example, machine, furniture. Intangible asset, an asset which cannot be seen and touched. Example, goodwill, trademark. Fictitious assets, assets which are not having any real value but created for accounting purpose. Example, preliminary expenses, discount on debenture, deferred revenue expenditure. The expenditure once made and benefit received for a long period for it. Example, advertising campaign, research and development expenditure. Accounting standard, the authoritative standards for financial reporting and specify how transactions and other events are to be recognized, measured, presented, and disclosed in financial statements. GAAP, generally accepted accounting principles. In short form, it is GAAP. It refers to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board called FASB. XBRL. XBRL, it refers extensible business reporting language which is freely available global framework of accounting standards and used for exchanging business information. Entity concept, ownership is different from business. Example, capital is treated as credit from the owner or owners in accounting. Dual aspect concept, it refers assets equal to capital plus liability in accounting. Going concern or going business or continuity concept, it refers the business will continue fairly long period until or unless business is closed. Example, assets are purchased for a long use. Money measurement concept, all the records are made only in money value for any events in accounting. Events which cannot be expressed in terms of money cannot be recorded in accounting. Cost or objectivity concept, this concept does not recognize the realizable value or the replacement value or the real worth of an asset. Example, land value is recorded only in cost of purchase irrespective of its realizable value. Cost match or cost merge concept, it is applied when a finished good is produced from the raw material. There are certain process and cost which are involved like labor cost, power and other overhead expenses. Accounting period concept, the accounts are prepared for a definite period, normally 1 year. In India, it is April 1st to March 31st. Accrual concept, revenue and expenses accrued for a particular period is recorded whether or not received or paid. Example, commission earned, rent unpaid. Matching concept, total income equal to total expense plus profit or loss. Realization concept or revenue recognition concept, profit should be accounted only when it is actually realized. Revenue is recognized only when sale is done or the services are rendered. Verifiable or objective evidence concept, all accounting transactions should be evidenced and supported by objective documents. These documents include invoices, contract, correspondence, vouchers, bills, checks, etc. Convention of disclosure, all significant information should be disclosed in financial statements. Example, mortgage loan on company assets. Convention of consistency. Rules and practices of accounting should be continuously applied without frequent changes. Example, depreciation methods. Convention of conservatism. It means playing safe. Anticipate and provide for all possible losses. For example, closing stock is valued at cost or market price, whichever is less. Convention of materiality. It means unimportant items may be dropped from recording. Example, rounding of 5 say treating miscellaneous expenses such as stock of stapler pins. Unit 2, Management Accounting. It is the process of preparing reports about business operations that help managers make short term and long term decisions. Comparative Statement Analysis. A document that compares a particular financial statement with prior period financial statements. Common size statement. A common size financial statement displays items such as a percentage of a common base figure on total sales revenue. It allows for easy analysis between companies or between periods for the same company. Trend analysis. It is an analysis of the trend of the company by comparing its financial statements to analyze the trend of market or analysis of the future on the basis of results of past performance. It is to make the best decision on the basis of results of the analysis done. Dupont Analysis. It is also called the Dupont Model. It is a financial ratio based on the return on equity ratio that is used to analyze a company's ability to increase its return on equity. Financial ratio. A relative magnitude of two selected numerical values taken for an enterprise's financial statements. Many standard ratios are used to evaluate the overall financial condition. Balance sheet ratios. It indicates relationship between two items of balance sheet or analysis of balance sheet items to interpret companies' results on quantitative basis. Turnover ratios. They are the financial ratios in which annual income statement amount is divided by an average asset amount for the same year. The turnover ratios indicate the efficiency or effectiveness of a company's management. Liquidity ratio, a type of financial ratio used to determine a company's ability to pay its short term debt obligations and its margin of safety. Solvency ratios. It measures how well a company's cash flow can cover its long term debt. Solvency ratios are a key metric for assessing the financial health and can be used to determine the likelihood that a company will default on its debt. Profitability ratios, a class of financial metrics that are used to assess the business ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time by using data from a specific point of time. Cash flow statement. A financial statement that summarizes the amount of cash and cash equivalents entering and leaving a business, and it measures how well a company manages its cash position. Fund flow statement. It reveals the reason for changes or anomalies in the financial position of a company between two balance sheets. Funds from operation. It refers the amount of profit from the actual business operation. It does not include depreciation, amortization, and losses on sales of assets. Any gains on sales of assets, any interest income. Adjusted profit and loss account in fund flow statement preparation. It is an account prepared to find the fund generated or fund lost from the actual operation of business during a period. Cash from operating activities. It indicates the amount of money a business brings in from its ongoing regular business activities. It is the first section depicted on a company's cash flow statement as per Accounting Standard 3. Cash from investing activities is section of the cash flow statement that shows the cash generated or spent relating to investment activities. They include purchase of physical assets, investments in securities, or the sale of securities or assets. Cash from financing activities is section of a company's cash flow statement which shows the net flows of cash that are used to fund the company. Financing activities include transactions involving debt, equity, and dividends. Now we will see the operating expenses. They are the expenses a business is incurring through its normal business operations. Example, rent, taxes. Non-operating expenses. Expenses that are not directly related to core business operations. Example, interest payments. Operating income. The amount of profit realized from a business operations after deducting operating expenses such as wages, depreciation, and cost of goods sold. Non-operating income, the portion of an organization's income that is derived from activities not related to its core business operations. Example, dividend received from investments. Non-cash expenses, expenses that do not involve any cash payment. Example, depreciation, amortization, depletion, asset impairment, etc. Unit 3. Cost accounting. Cost accounting is a form of managerial accounting that aims to capture a company's total cost of production by assessing its variable and fixed cost. Absorption costing, a method of costing for accumulating the cost associated with production process and apportioning them to individual products. Job costing. Job costing is a costing method used to determine the cost of specific jobs which are performed according to the customer's specifications. Process costing, a method of costing used mainly in manufacturing where units are continuously mass produced through one or more processes. Batch costing, it is used where articles are produced in batches and held in stock for assembly of components to produce finished products or for sale to customers. Contract costing. Contract costing is the method of costing applied in a business where separate contracts of a non-repetitive nature are undertaken. joint product and byproduct costing, where two or more products come out of a single raw material which is equally important. They are referred to as joint products. Example, from crude oil, the petrol, diesel, kerosene and tar manufactured. Cost sheet. It is a detailed presentation of cost, selling price, and profit for the production of goods and services for a particular period as per the cost sheet format. Tender. It is a statement of cost and selling price to be quoted for a specific job order or any event. ABC, that is activity based costing. It is a methodology for more precisely allocating overhead cost by assigning them to activities. Once costs are assigned to activities, the cost can be assigned to the cost objects that use those activities. Cost objects. The cost objects refers the products, the customers, services, locations, etc. Cost driver. The cost driver is the unit of an activity that causes the change in activity's cost. The causes for occurrence of overhead cost are known as cost drivers. Example, quality inspection, purchase order, etc. Cost pool. It is a grouping of individual costs, typically by department or service center. Cost allocations then made from the cost pool. Target costing, a system under which a company plans in advance for the price points, product costs, and margins that it wants to achieve. Opportunity cost, the benefit lost due to alternative use. Example, using one premises for office will lose its rent. Imputed cost. It refers to the cost of an asset, service, or company that is not physically recorded in any accounts. Example, an employee leaves the job to go for higher study. Sunk cost. It refers to money that has already been spent and cannot be recovered. Example, cost of machinery. Out of pocket cost, the direct payment of money that may or may not be later reimbursed from a third party source. Example, when operating a vehicle, the parking fees and tolls are considered out of pocket expenses for a trip. Defective. Products or units which do not meet with dimensional or quality standards and are reworked for rectification and will be sold as seconds normally. Example, overcooked food items. Spoilage. It is a standard amount of waste or scrap that is caused by production and which is difficult to avoid. Example, fruits. Salvage value or residual value. It is the book value of an asset after all depreciation has been fully reduced or after its useful life. Example, machinery. Normal loss. Expected loss in normal production process. It will be absorbed by good units. Abnormal loss. The actual loss which is more than the expected loss in production processes. That is called abnormal loss. The value of this abnormal loss will be transferred to costing profit and loss account. Abnormal gain, when the actual loss is less than the expected loss, it is abnormal gain in production. It is transferred to costing profit and loss account. Unit 4, Marginal costing. It is a costing technique wherein marginal cost, that is variable cost, is charged to units of cost, and the fixed cost for the period is completely written off against the contribution. Marginal cost, the cost associated with producing an additional unit of output. It is calculated as the change in the total production cost divided by the change in the number of units produced. Fixed cost, cost that do not change when sales or production volumes increase or decrease. It remains same irrespective of production up to a capacity level. Example, rent. Variable cost, the cost which vary in accordance with the number of units produced. Example, direct material. Semi-variable cost. Semi-variable cost is also known as semi-fixed cost or a mixed cost. It is a cost having both fixed and variable components. Such costs are fixed for a set level of production or consumption and become variable after this level is exceeded. Example, electricity charges. Prime cost, it is a combination of direct material, direct labor and direct expenses. It is the first part of cost sheet. Work cost, it is the combination of prime cost and factory expenses. It is a second part of cost sheet. It is also called production cost or manufacturing cost. Cost of production, it is the combination of prime cost, factory expenses and administrative expenses. It is the third part of cost sheet. Cost of sales, the total cost, that is the combination of prime cost, factory expenses, administrative expenses and selling and distribution expenses after adjusting opening and closing finished goods. BEP, the break-even point. The BEP is the point at which total cost equals total revenue. No profit and no loss point. CVP, cost volume profit analysis. CVP is a way to find out how changes in variable and fixed costs influence a firm's profit. CVP is used to see how many units need to be sold to break even or reach a certain minimum profit margin. Margin of safety, it refers the difference between the actual sales and break-even sales. It helps to know how much sales can decrease before the company or a project becomes unprofitable. Profit volume ratio, in short form it is called PV ratio. This ratio is the measurement of the rate of change of profit due to change in volume of sales, usually expressed in percentage. This ratio shows the amount of contribution per rupee of sales. Key factor, it refers limiting factor or deterring factor on sales volume, production, labor, material and so on. The limiting factor studied with contribution and has the inverse relationship with the volume of contribution. Unit 5. Budget. It is an estimation of cost and revenue for any event for a particular period. Budgetary control, it refers regular comparison of actual income or expenditure to planned income or expenditure to identify whether or not corrective actions required. Cash budget, it is an estimated cash expenses and revenues for any event for a particular period. It helps to decide the cash position for that period. Sales budget. It is an estimation of expected sales in details, product wise, place wise, etc. for a particular period. Production budget. It is an estimation of production units and production cost for a particular capacity or number of units to be produced during a period. Fixed budget. It is an estimation of production cost and revenue for a fixed capacity level or fixed units of production. Flexible budget. It is an estimation of production cost and revenue at different capacity levels or different units of production. Zero-based budget. Zero-based budgeting, in short form, it is called ZBB. It is a method of budgeting where all expenses must be justified for each new period. The process starts from zero base. It was developed by Peter Fir in the 1970s and was first introduced in Texas. Profit planning, the estimated profit at different capacity levels or for different units of production for a particular period. Standard costing, a system of costing that uses predetermined standard cost for direct material, direct labor, and factory overheads, and variances are analyzed for taking right decision for cost control. Standard cost, it refers the predetermined or estimated or budgeted or expected cost. Variance analysis, a controlled system that is designed to detect and correct variances from expected cost to actual cost. Material cost variance. Material cost variance, it refers the difference between the standard cost of material used in actual production and the actual cost of material used. It may be adverse or favorable. Material price variance, it refers the differences between the standard or expected price and actual price for the materials used for production. It may be adverse or favorable. Material usage or quantity variance, it refers the differences between the standard or expected quantity and actual quantity of materials used for production. It may be adverse or favorable. Material mix variance, it is the difference between standard and actual mixture of materials used for production. Material yield variance, difference between the expected yield and actual yield in using the materials in production. Labor cost variance, difference between the expected labor cost and actual labor cost in production. It may be due to rate, efficiency, number of employees, idle time, etc. Labor rate variance, variance of labor cost due to the difference in expected and actual labor rate. Labor efficiency variance, variance of labor cost due to the difference in expected and actual output. Idle time variance, difference between the expected labor cost and actual labor cost in production due to the labor idle time. Calendar variance, it is that portion of the volume variance, which is due to the difference between the number of working days in the budgeted period and the number of actual working days in the period to which the budget is applicable. This is related to this labor cost variance. Now we will see accounting standards in practice in India. Ministry of Corporate Affairs, in short form MCA, has to spell out the accounting standards applicable to companies in India. As on date, Ministry of Corporate Affairs has notified 41 Indian accounting standards. Disclosure practice in accounting. It refers to the timely release of all information about a company that may influence the investor's decision. They are the both positive and negative news, data, and operational details that impact in business. It is done as per accounting standards used in India.